This is a real problem for the Fed. They can't have another bank crisis, meaning their only alternative is to liquefy again. And that's what gold knows. That's what gold ultimately responds to, is the degradation of the money unit.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 22nd through January 29th, 2024, while supplies last. First, we feature pre-1933 gold $10 and $20 Liberties at $89 over melt and $139 over melt, respectively. Next, backdated 1-ounce silver maples are at $3.75 over spot with a minimum order of 50. We also have backdated quarter-ounce gold maples at $59 over melt when you purchase 2 or more. And finally, backdated 1/10-ounce gold maples are just $32.50 over melt with your purchase of 4 or more coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver, and also on the MSA team is Bret Oliver with us today. Michael and Bret, thank you so much for joining us today.
Thank you.
Good to be here, Elijah.
Well, it's great to have you both today. I wanted to start with Michael. If you can give us an update on really since the beginning of the year, where we have been in both gold and silver. It seems like we had a pretty exciting December, but things have cooled off a bit, it seems like, in the prices. And also I've noticed in the retail side of things, not a lot of demand right now.
Well, the gold market had that surge December 3rd or 4th, the first day of the December, where you went up and finally hit the stops, the buy stops, no doubt, shorts covering their losing positions, late longs coming in at 2,100, okay? And you gushed within 45 minutes up to 2,150. Why? Because it was in the dark. 2, it had to be a massive amount of buy stops there. And so they were elected and it just whooshed, okay? But once all that buying dissipated, literally within that first hour, there was probably a void below. And so anybody who came in and sold, and I think the BIS actually did sell, dropped it immediately back down. And within 6 days of that high, gold traded down to 1980. Okay. Since then, gold launched back up to the upper 2000s and has never taken out that 1980 low that we made 6 days after that high. So you could basically take early December, second week of December, and we've been caught in between since then. A lot of selling, but this time, unlike last year, March to October, where it went down, a couple $100, or that 2022 drop, it dropped 20%. This time, the selling has just created wheel spinning. Okay. And I think the bears have run out of the clock. I think, they needed to do more than they did. And all of a sudden yesterday, if you'll notice, while gold is still spinning here in the lower 2000s, silver shot up $1. Very interesting, very curious. And the miners have begun to stabilize again. And of course, they're always lagged to gold. At some point, they won't be. So pay attention to that. We measure that and we issue that in our reports. But I think gold is doing well. It's hanging in there despite the constant doubters. And they are abundant. Even among the gold bulls. And I would say that this next upturn that we're probably on the cusp of right now, the next daily, weekly upturn, could be the one that engages us. And I would give you a number. You get much back over 2,100 gold again? Expect it.
Now, one thing that I see as significant is that we really haven't seen a good amount of time that gold has sustained the levels above 2,000 until now in December and January. Your perspective on this, Bret, any more insights on where we are in gold right now?
Yeah, that's a good question. So obviously, as my dad said, even the gold bulls now seem to be bearish on gold. In the short term, at least, expecting another dip. You see targets like 1,800 something, maybe just like test the 200-day line again, which is 1980, something like that. And I mean, that's entirely possible. But instead, what's really happened here is now gold is, I think, into its 8th or 9th week, actually living above 2,000. That is a total change for gold, where before, everybody knows each peak that gold has had above 2,000 up to 2050 and change, it just immediately gets slammed back down. So you have to take note of that tonal change. And so far, the short-term correction we've had has just retraced ground from early December. So, you are just stuck in this range, just above 2000 and 2100 at the high. So mostly I would call that a correction in time instead of in price. And so it's frustrating to the bulls, and it requires patience, of course. And, and as my dad was saying, like I think this next turn in daily and weekly, and we're watching a lot of shorter term things like our 3-week averages and such, that they're set up very nicely here to say, it could even be this week. We'll have to see. We've had so many hits from all this economic data. So it may end up being next week, but they're getting very close here to a short-term upturn, which could trigger those higher numbers. So we're patient here, but we're not, I would say we're not bearish in the sense of expecting a retest of the 1800s. So this is, I think we have to take a win here as far as them living above 2000. That's a good sign.
I'm wondering if there might be some misplaced confidence as well in the stock market as we're seeing all-time highs here. People back in 2022 were very concerned about the stock market as it was being hit quite a bit, and they were looking at their 401k, they were looking at their IRA, and very concerned, and people calling us up saying, I don't want to lose more. Now that we're seeing all-time highs, it seems like maybe there's less interest in these alternative asset classes. Your take, Michael?
We think it's entirely extremely limited leadership. It's mostly tech, almost all tech. In fact, it's a narrow segment of the tech sector that has made all-time new highs. In fact, if you look at XLK, which is the tech ETF, only 25 of the 61 stocks at our last measurement have made a new high. So even only about a third or 40% of that tech sector has marginally taken out the 21, 22 highs. NASDAQ 100 has nipped it out by a couple percentage points. No big deal. It's 2021 high. S&P has only marginally taken out its high by a percent or two. But when you look within the indexes, you'll see the stocks that did it are like Apple, Microsoft, NVIDIA, And when you go, I suggest to all your listeners and watchers that they go to their quote screens and type in a bunch of ETFs of sectors within the S&P that aren't tech. Example, XLP, consumer staples, XLY, consumer discretionary, which used to be a leading sector all during the bull market from 2009 to 2021. It's only 2/3 of the way back to its high. Look at retail, XRT. It's laying there dead comatose, 50%, 50% back toward its high, but just comatose. Despite all the talk we hear about, the consumer is strong. If you look within the stock market, you'll see it is exceptionally narrow, and that is not good for the bulls. Plus, our technical assessment of the leading stocks and the minor tech sectors that are leading this is that they're extremely vulnerable for a downturn. They're in what looks like a blow-off type mode. And when those things turn, they often turn savagely. And we're trying to measure that, the timing of that.
And what is, if we can turn to Bret here, what is momentum showing you with respect to the stock market? I believe in, Michael, in one of your recent posts on the NASDAQ, you were saying that this run-up are definitely concerning developments with respect to momentum here. Any thoughts on that, Bret?
Well, I think the scale of momentum that I would look at here is to take us back to the long-term view. And I say that because I think that's really what MSA is best at, is this long-term viewpoint. And, and I know that nowadays most people don't, or at least they say this, and I've seen some statistics on it that holding periods for stocks are, the lowest that they have really ever been. So nobody really thinks about holding long-term anymore. But with our major, sell signal, if you want to call it that, or topping signal in late 2021, early 2022. Well, since then, the S&P is back there just slightly above it. NASDAQ also just slightly above it. So from that perspective, the long-term momentum is saying This is a non-confirming high. You're nowhere near those prior momentum highs, which were a blow off from post-COVID, excess. And then in terms of specifically the tech sector, which is indeed leading the charge, all of these stocks like Nvidia, especially, or Microsoft, are so far stretched beyond long-term means at this point. And of course, their bounce point was October of 2022. So now to be buying and chasing here, I feel like it's just a dangerous proposition when the risk is just ever increasing of another mean reversion. So, what's going to trigger that? In terms of the why, well, we don't really, look at that so much as, again, just the technicals, what the momentum is telling us. And so to sort of time the top here, we're looking at very short-term things. And our subscribers have seen that in our recent reports on, on the NASDAQ, on NVIDIA. So they know we're monitoring that. But I think that would be my biggest point here is just the long-term momentum said get out 2 years ago, aside from a very, very small group of stocks, nothing has changed in that regard. So yeah, that would be my biggest take on that.
So it seems like there's not as much excitement in the stock market that you'd maybe expect as it's hitting all-time highs. There's definitely not as much excitement as we saw back in the post-COVID run up. Is that correct, Michael?
Well, I think the excitement is there, but it's very narrow. And again, if you look at the other sectors and you say, well, how's my retirement account doing? Well, if you're in NVIDIA, it's doing well, okay? But you've got to be in half a dozen stocks to be outperforming the level where MSA said, be gone, okay? Every index out there, except a few stocks within the S&P, heavily weighted in NASDAQ 100, for example, and the tech sector, have taken out those highs. But you had to wait 2 years for that to happen, okay, to finally get back up to where we said get out. But most sectors are well below that level. So the stock market in general, if you really want to put quotes around stock market, it's not back to where we said exit. And I think once the tech sector has its little bubble popped, and I think this is a temporary bubble, it's like, for instance, if you look at NVIDIA on a price chart, there was this big surge up to $500, and then this range, multi-month range, where there was sellers, and it was capped, okay? And what we call a distribution range. So there were doubters taking their profits, who got in well, But then we burst beyond that up to 600. And when you look at the price chart and use orthodox analysis, you think, oh, that was a range, that's a midpoint range for a swing move. No. It's highly likely to be a bull trap. In other words, that distribution range was a valid indication of smart money moving out. Now, the late money is spiking it up briefly. It's only a couple of weeks now, by the way, above that level on NVIDIA, for example. If you abort back down into that price range, watch out. The downside could be very rapid. And we've got some momentum metrics that will be triggered even before you get back down, let's say, into the 500s on NVIDIA. And a similar situation on a lot of the tech stocks as well. So they're very dangerous. It wouldn't take a sneeze for them to really drop sharply. And if they drop, we all know what's going to happen. They will take the market because they're the metrics that have caused the market to come back up. Okay. So I think it's a very dangerous, pivotal situation here.
Now, I know our viewers are concerned about the stock market, obviously, those who are invested in it. Now, there was a big scare last year in the March-April timeframe with the banks, and a lot of people were concerned about their money in the bank. Should they have over $250,000, etc.? That was a big concern for a lot of people. It seems like, at least in the mainstream, that concern has gone away. But I know, Bret, that you have done research on bank stocks recently and have some new insights. Can you share with us kind of your insights into the banking system right now?
Yes, of course. Happy to. So what I'm seeing right now is, everybody should be aware that the liquidity the Fed has pumped into the system is draining away. And that by the end of March, the BTFP, or Bank Term Funding Program, should be closed out. And the reverse repo market also being drained. So all these sources of liquidity that are not QE Obviously, it's they're not purchasing bonds, right? It's another means of getting liquidity into the system. They are going to run out, and they have not said they have any intention of starting them up again. So, what's going to happen to all of these banks, especially lesser ones, who are very likely relying upon this money? I mean, return to the banking crisis situation again, is they papered it over. So, I could see a scenario in which we have yet another, small banking crisis like we had with regional banks, where they're once again exposed to this risk. And, JP Morgan's of the world just getting bigger, eating up these little guys, because that's who always benefits from this. And then, add on top of that, we have insane levels of fiscal spending. And that shows no signs of slowing down. In fact, the level of fiscal spending we're at now is as if we were already in a recession. So, I mean, imagine if, of course, we're never going to have a recession again. I know they'll just define it away or something like that. But, and everyone believes we're going to have a soft landing now. So what happens if we really do have a recession? What's the fiscal spending going to look like then? So I just think this tough talk from the Fed, which is obviously sort of transformed into holding rates steady as opposed to hiking any further, that will shift at some point, and I think it'll be pretty sudden, as it normally is, to rate cuts and back to more liquidity into the system. That's what they do. This is ultimately their job, basically, is to pump liquidity into the system. So, that's what I see, and I think you need to watch bank weakness again as a sign of that. And any time that you see the bond market caving, which it has been having a sell-off recently, that is something that we anticipated, and we don't think that can continue much further for all the reasons I stated. So I think watch that bank weakness. It's just another sign of what the Fed is going to ultimately have to come in and do. And if there is a crisis in terms of more regional banks going under, then that'll probably be your sign. Maybe they step in before that. I can't predict what bureaucrats are going to do, but definitely watch the bank stocks here.
Michael, your perspective on that and how this will impact the precious metal sector, because I know back in March and April of last year, we did see a rush into precious metals, and the price of gold rushed higher amid the banking crisis. So if we have this issue in the stock market and we also have a further crisis in the banking system, it seems like that would just be extremely positive for gold and silver.
Yeah, I think gold is not a follower market. A lot of people think, well, if this government data point does this, gold will sell off. Gold has been around 3,000 years. Okay, UST bond's been around, 100 years, something like that. And the stock S&P has been around since the 1950s. Okay, it's an old and wise market. It's always been money. It still is. It anticipates macro events. It doesn't wait for headlines. And yes, you're right. Back last spring, the banks had a crash, literally a dimensional crash, where in a number of weeks drop 30-something%, that's a crash. We called that in late January. MSA had a technical reason. We didn't explain why. We didn't know why, but we could see they were going to collapse. And they've been an outperforming sector then. We're talking early 2023 now. And sure enough, in February, March, they hit our trigger numbers and crashed. Since then, we've had this crawl back based on, the Fed's going to take care of things. Don't worry about it. Okay, well, we'll see. Meanwhile, banks aren't back at their highs. Okay, they're not doing what the S&P's doing. So we're watching them very closely. And Bret's observations are dead on. This is a real problem for the Fed. They can't have another bank crisis, meaning their only alternative is to liquefy again. And that's what gold knows. That's what gold ultimately responds to, is the degradation of the money unit, meaning the liquefaction of the system. And so gold knows that. And that's why, even though banks have rallied, gold has not caved. Okay. We had a good surge into early 2023 and then this protracted pullback. And now we're sitting up there. How come we're still sitting up at the highs in gold, basically, while the banks have had a rally? Gold knows better. It knows the bank rally is not sustainable. And And I would also watch the broader financial sectors as well, not just the banks. I know everybody's looking at that, but watch for example, XLF is a good ETF to watch for the broad financials. But the Fed is very nervous about this. They have to be. And the other thing they're nervous about is their T-bond market. It crashed last year. We called the nuke event, and sure enough, in August, September, and October, the T-bond market went down in a crash mode. Rates went up to new highs. Took out the price low of October 2022 vastly in October of 2023. It was an uncontrolled decline, and that had to panic the Fed. And I'm sure they probably came in and helped support that market in the dark. But now that market has already given back a third of its gains, price gains, T-bond market. They got to get a little antsy right now. So what does that mean? Well, if they get antsy, that means somewhere down the road here, probably sooner than you think, data points or no data points, they're going to have to reliquefy. That's what gold knows.
Now, it is interesting. You mentioned how gold has been around for thousands of years. We look at the new kid on the block, Bitcoin, only 15 years it's been around, but it seems like some people look towards Bitcoin as an alternative currency, a safe haven in times of crisis. Based on your current analysis of the momentum structure in Bitcoin, what is it telling you, if we want to go to Bret, about, are people looking at Bitcoin as a safe haven, as an alternative right now?
That's an interesting point. I'm not, I will say I'm not an expert on Bitcoin like some others out there. And, but in terms of technicals, at least, we did call this rally recently. For a while, we were sort of tepid on it, pointing out the very strong resistance of 30,000. And eventually we had enough signs that was going to be overcome. At this point, that rally is starting to fade, though. And so we'll have to see if that can actually hold support on a back test here. And if, was that it? So we're just going to have to wait to see what Bitcoin does there. But that it is interesting that it has in a way diverged from the stock market, and that it used to be following that fairly closely, I would say. And more recently has shown signs of perhaps behaving a bit more like gold. So I think there is an argument that could be made there that people do see that as another potential safe haven, if a, shall we say, very volatile one. In that way, perhaps not so different from silver. But yes, no, I think you could still make that argument. Again, technically, we will just have to see if this current correction will hold support and reassess from there.
Yeah, I mean, my perspective is it's like we have to wait and see, because Bitcoin isn't tried and true yet, right? Like gold is for the last thousands of years. But your take on that, Michael, do you think people will also rush towards Bitcoin as this crisis in the banking system and stock market mature?
Yeah, technically, though, the level that needs to hold, we're testing it right now in Bitcoin. We had a target on the upside after it crossed through that 30,000 zone. It wasn't because of price. It was a momentum-based target that it would get above 45,000, and it got to 45,100 or something, and then elapsed. Now back to 39,000. There's levels around here it needs to hold. And the same with Ethereum. We look at them both. Ethereum is weaker than Bitcoin, but still, we look at them both. And you pull back much further, and there's questionable about what's going to happen next. And yes, there is the virtue of Bitcoin in that it is not infinitely printable. There is a limited supply, okay? Unlike government fiat currency that has no limit whatsoever. And that is the virtue of Bitcoin. One of the unvirtuous things about it, though, is that the government can pretty much track it. And, they've been coming down around the world in terms of wanting to control, regulate, and, scrutinize the cryptos, and even create their own, which, of course, would be a fiat crypto. Okay. So it does have some virtues, but it isn't gold. And so its volatility is definitely quite dangerous in terms of the percent swings. But right now, it needs to be holding around where it is now. And if it doesn't, you drop another 1,000 points in Bitcoin, it gets pretty soft again. So we're on the fence on that. It needs to hold right around here. Because it hit one of our major targets above 45 and then immediately relapsed for some reason. We know why, but technically, but anyway, I would focus on the monetary metals. They've been around thousands of years. They've proven what they are, and you can't fiat them. Okay.
Michael and Brett, we really appreciate your time today. Did you want to share with our viewers any last thoughts you had? And also tell us a little bit about Oliver MSA Momentum Structural Analysis, olivermsa.com.
I would say, yeah, we're just in this sort of waiting point here on gold. You just need to be patient right now. Allow this very short-term correction to run its course. And again, it's mostly so far correction in time rather than price. We've not collapsed here like many have anticipated. And in terms of, the stock market, I would not want to chase it here. Tech, at least, I would not want to chase tech here. It's just in a very precarious situation. So, I think that's nothing else I can really say there. And as for MSA, well, we've been doing it, or I should say, my dad has been doing it for over 30 years. I joined him about, how many years ago now was it? 10 years ago. So I've been doing it for 10 and grew up around it, of course, but, didn't really get involved working directly with him until 2016. And, it's, I can't imagine doing anything else. It's what I love to do. So I'm just as obsessed as my dad.
Fantastic. Well, thank you so much, Michael and Brett. And one of the things I really appreciate about momentum structural analysis is the unique approach, obviously looking at momentum rather than just price. So we really appreciate your insights that you give our viewers. And yeah, thank you so much for your time, and God bless.
Thank you very much.
Thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 22nd through January 29th, 2024, while supplies last. First, we feature pre-1933 gold $10 and $20 Liberties at $89 over melt and $139 over melt, respectively. Next, backdated 1-ounce silver maples are at $3.75 over spot with a minimum order of 50. We also have backdated quarter-ounce gold maples at $59 over melt when you purchase 2 or more. And finally, backdated 1/10-ounce gold maples are just $32.50 over melt with your purchase of 4 or more coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.